Welcome guys, it's your boy Jay and welcome back to my channel where we talk about all things stock and investing. In today's episode, we're going to talk about how to invest $1,000 into the stock market. Before I go ahead and dive into the video, please go ahead and subscribe, hit the like button, also hit the notification bell. It really helps my channel grow. And just so you guys know, in the description I have links to Robinhood and I have links to Acorns. We both get a free stock if you do Robinhood, or we both get $5 if you do Acorns, if you sign up for there. Who doesn't want free stocks and free money? Now, like I said, in this video we'll be discussing how to put $1,000 into the stock market. Now, before we actually do that, you have to ask yourself a couple of important questions. First question is, am I okay with losing this $1,000? Now, it's a reality that most people don't want to face, but it's a possibility that whatever investment you put the $1,000 in, it could go completely south and leave you with $0. And you have to be okay with this possibility. Make sure that this $1,000 is disposable income for you. You know, you're just trying to grow yourself. This isn't money that you desperately need, where you're trying to, put this on like a play where, you need, let's say for example, you need $2,000, you're going to put this all in Tesla stock tomorrow and hope that it doubles. So it's nothing like that, because it can go completely south for you. So if you're okay with losing this $1,000, next question you need to ask yourself is, what are my expectations for the $1,000? Do I want it to double, triple in a short period of time? Do I want it to perform steadily over periods of years? And what's your risk adversity to this? Your risk tolerance. Are you high, someone who you're willing to go high risk? Are you medium, low? You have to ask yourself all these kind of questions. And depending on what you pick, I might have something for you today. So, first strategy or first way that you can invest your $1,000, depending if you're a high on the risk factor, is you can go with leverage. What is leverage? Basically, you're borrowing money from the broker to multiply your earnings. Now, an example of this is, let's say we find a broker. They have a 1 to 10 ratio, right? So you put your $1,000 and they'll put 9, having a total account of 10 grand in your account. You invest in something, let's say you invest in Apple, Apple goes up 10%, now you have 11 grand in there. You come out of the play, you give the broker back their 9 grand, now you have $2,000 in the account. You essentially double your money on that play. Now, sounds good, and it's very profitable for a lot of traders who who've been in the game for a long time. I definitely recommend this is not something that beginners jump into. Get your feet wet into the stock markets first, and then as you start to develop your own style strategy and you start to see profitable gains over a period of time, I say, hey, jump into this. It's more of an advanced kind of thing. Besides, just as easy as it is for you to make money, it's very easy for you to lose money. Your $1,000 or whatever your investment is the margin for loss. So let's say you do a play and the play goes bad, you lose $1,000. The $1,000 is completely yours. You never touch the broker's money. Once the broker sees they're about to, their money's about to be touched, they pull you out of the trade. They normally leave you with a little bit of your money in there, but they pull you out of the trade and they take your money back. So it's very easy for you to multiply your gains, but it's very easy for you to multiply your losses. So just be careful with that. Another good advice is make sure the broker that you're going to choose, if you want to go with the strategy, they have what's called a policy, negative balance policy, I think it's called. So basically, they only allow you to lose money that you put in, because I know very few brokers, they allow you to do a negative balance, meaning that you owe them money at the end of the day. So just make sure you check that out before you move forward. Now, another option, if you're still kind of on the risky side, but it's a little not as risky as using leverage, is options. I recently just made my first options play today. And normally when I try to explain options to my friends, I always end up rambling and confusing them. But for the purpose of this video, I'll try to make it as simple as possible. Now, what's options? An option is a contract giving the buyer the right, but not the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. A real world example of this is, let's say for example, I have a car that's worth $1,000. You want to buy that car from me. You draft up a contract saying that you will purchase the purchase the car from me in the next 2 weeks, so 14 days from now, at $1,000. I say I agree to the contract, but because I'm holding the car for you during this period of time, you have to pay me a premium, $100, and I'll hold the car for you. Now, something miraculous happens during this period of time, and my car is now worth $2,000. The value has doubled. You have a contract, you have the right to go ahead and buy the car from me for $1,000. Which, if you exercise that right, you could buy it, sell it, make $1,000 profit. Or another option you have is you can sell the contract. Now the contract has intrinsic value to it, so you could sell it to, let's say you don't have $1,000, right? You could sell the contract to someone else for maybe like $500. They buy the car for $1,000, and they can sell it for $1,500. Either way, they've made a profit on the car, and you've also made a profit because you sold the contract. So that's kind of how options work. Instead of a car, you're going with stocks, and the contract is normally 100 shares worth of stocks. And because you're working with 100 shares, that's why you normally have that huge multiplier effect. And also because your contract has intrinsic value, it also has like a multiplier effect as well. So it's a good way for you to make rapid gains if you're kind of on that risky side and you want your $1,000 to start working faster for you. Another third option for kind of risky plays, and not one that I recommend, but I also did make a Spac play myself, is investing in Spacs. Now, I have a video on what are Spacs if you need to go ahead and I'll leave a link in the description for that video. But essentially, they're companies that are kind of new in the market. They're going to be acquiring another company, so they're going to merge. And normally, news of mergers, especially if they're potentially successful companies, the Spac tends to spike, giving you a nice little return. I think I invested in CCIV, which is a company that's going to be acquiring Lucid, which is an EV company. Basically, it's supposed to be something similar to Tesla. I jumped in at 17. I think right now it's sitting at around $24. So I opened a small position, so I'm not making crazy profits or anything like that, but the money has gone up since then. So that's one option you could take. Now, if you're a little more risk adverse and you want to play things on the safer side, you can kind of follow what I do, which is I have a diversified portfolio. So basically, I have a little bit of everything in there. So I have a little bit of Spacs. I have a little bit of companies that have been around for a long time, like Apple. I have companies that are dividend stocks, growth stocks. That's one of the best things. So you just do a little bit of everything. If you're not sure, what to put your money in exactly, you can also do invest into ETFs. Now, ETFs are basically funds of a whole bunch of different stocks compiled together. You can look up very popular ones, like for example, VU. It mimics the S&P 500, which are the 500 top companies in the States right now. And you're normally safe. You get around a good realistic number of returns is somewhere, I would say, between 8 and maybe 12, 13%. There are times where it exceeds that. I think last year VU did 18%. Fact check me on that. But either way, they normally do a good job, and you can see slow and consistent gains if you do that route, if you invest into ETFs. Another strategy is you could just do dividend stocks, and that's one thing that I adding to my portfolio as of this year. I'm investing in a couple of dividend stocks. So, for you guys, I would say, invest into blue chip stocks, invest into companies. If you're going the dividend route, which is going to be the safer route, it's going to be a little slower, but it's still good. And for you guys who don't know what dividends are, basically the companies paying you, to keep the stock. So for every share you get a percentage back from their revenue. So it's a good deal. It's free money basically. And you know, when you reinvest it, you acquire more shares, and therefore in the future you get more dividends. So again, good deal. But yeah, there are different dividend companies that you can look into. I would recommend, again, blue chip stocks, also dividend kings and dividend aristocrats, which are basically companies that have been increasing their dividend yield over the last 25 and 50 year period, I believe. So they normally, you know, pay out and increase their payments throughout this entire time. So it's a good deal. And I think with that, I'll wrap up the video. If you found this video informative, please go ahead and, you know, leave a comment. If there's anything you want me to go ahead and review in detail that I mentioned in this episode, also go ahead and leave a comment. Remember to like, share, subscribe. And I appreciate you guys watching the video if you stay to the end.